year to date, when we look in the stock market, we can see some mixed results all across the board. When we focus on Microsoft, we can see it is up single digits, 8% just over the last few months. And in today's episode, we are focusing on whether or not this is a strong undervalued buy now for a quality company that is down around 4% over the last month. Now, we can note from Wall Street, they do consider this to be a very strong buy, and in today's episode, we are doing a deeper dive into a company we haven't looked at in a while. We're going to look at their top line revenue growth year on year, as well as their bottom line net income growth. We want to look at the health of the company, their total cash versus their total debt, and we'll, as always, look towards both insiders as well as institutions as to whether or not they have been adding this company. Now, last week, they did in fact report their earnings, so we are going to dissect some of that information. We're not just going to look at their third quarter results, which was released just a few days ago, but we also want to take a look at their outlook for the next quarter as well as the full year of FY25 to understand where the growth is going to be coming from. And as always, not only will we look at their dividend safety, which looks impenetrable at 99 score, but also a lot of their metrics over the last few years, free cash flow, ROIC, net debt, and many others. And as always, we will run them through the valuation model, getting to both our intrinsic value, our acceptable buy price when factoring our investor margin of safety, but also looking at Wall Street and their own forecast for the next 12 months, considering they see this as a massive strong buy now. So let's start off with a very high level look at how their latest earnings was, and we can see the headline reads that their cloud growth accelerates on the back of AI push, so that is some good news for shareholders, and we can see their third quarter results exceeded estimates on both the top and bottom line. However, one thing to note that we will look at very briefly is that their revenue guidance was lowered slightly. What we can see is the finance chief said they are expecting around 64 billion in revenue. However, we can see analysts were targeting around 500 million more at 64.5 billion. And what Microsoft have been doing is increasing a lot of their capital expenditures, buying a lot of the NVIDIA graphics units so they can start running and training a lot of artificial intelligence models, something that we are hearing a lot in the market over the last few months, with AI being a lot of talk for a majority of companies. Now, how exactly did they do? We know they beat earnings per share 294, analysts expecting 282, so a nice healthy beat. With the revenue as well, we can see in fact more than a million beat, 61.86 versus the 60.8 billion. And as we mentioned, we do note here, however, that they did lower their forecast from that 64.5 billion to around 64. However, what they are anticipating is some growth in their operating margin of 42.3% versus the analyst target of 41.5%. So pretty strong across the board. We will look at this in more detail. This was just our first high-level review. And now let's look at the historical performance. Now, yes, over the last month, it is down 4%. We do know, in fact, it has cooled down from the 52-week high that we saw not too long ago at $431. And over the last year, if you have been a shareholder, you would be very happy, up 38%. Bear in mind, it doesn't include those dividends reinvested. For this company, on a forward-looking basis, it does sit at 0.74%. And longer-term shareholders of this phenomenal company would be up over 931%. Again, it would be over 1,000% if you have been reinvesting those dividends. So let's take a quick look at the numbers. Now, yes, typical companies, 3 to 7% growth year on year is what we target. However, for a monster like Microsoft, we do expect a lot more. And as we can see, they have more than doubled their top line from 86.8 billion in 2014 to 212 billion in their latest annual report. So lots of good signs there. They are growing year on year. As we can see, when we do take a look at their top line revenue growth, it does move in the direction that we do expect from this company. And we can see it isn't too far away from releasing their annual accounts for June 2024. And based on the trailing 12 months, we are expecting to see some very strong growth at double digits. Now, when we take a look at their bottom line, as always, top line, we want to see growth, and on the bottom line, net income we can see has gone from 22 billion in 2014 to 72.4 billion. So some very strong growth there, more than 3 times. And we also note that the trailing 12 months shows a lot of positive signs. They are anticipating strong growth to their top line as well as their bottom line. In fact, double digits for the full year. And again, when we look at the graph, yes, some inconsistencies, but overall it does move in the right direction that we do want to see from any company that we are investing in. Now, how about the essential health of the company, their total cash and short-term investments versus their total debt? Well, we note 85 billion sitting on that balance sheet in 2014. Now, their latest annual accounts showed 111 billion. However, their latest quarterly report, so that would have been after June 2023, does show 80 billion. So we can see their cash position has gone down, in fact, in the more recent period from 111 to 80. Over the longer term, though, we do see that cash, whilst it has increased, has started to come down from the highs of June 2020 that we did see here at 136 billion. Now, this isn't a red flag indicator, just something to highlight. Taking a look at their total debt numerically and directionally, it has increased from 23 billion in 2014 to just over 106. So very rapid increase, as we can see over the period. And in fact, now for one of the first times, we do note that their total cash position is smaller than their total debt. Now, it isn't a red flag indicator. In fact, they do have globally one of the best balance sheet ratings, similar to that of Johnson & Johnson, and just something for us to highlight and analyze further when we do look at that net debt to EBITDA metric. So a few ratings that we want to take a look at. The first one is their growth rate, and we can see here a grade of a B-. Few things to highlight. Well, their revenue growth year on year, double digits, 14%. Sector median does come in under 4%. Forward looking, again, they are anticipating double-digit growth, and we can see, even though the sector median is expected to be higher than what they had year on year, still significantly lower than that of Microsoft. We can see a very similar trend across the different metrics, and when we do take a look at the earnings per share on a forward basis over the next 3 to 5 years, we do note it isn't too far off what the sector median is targeting at 13.84%. But overall, they do get a B- grading, and you can see there are other metrics, so do take a note if you would like to analyze further. We then look at the profitability. Well, an A+, so the highest score that they could obtain. On a gross profit margin, very high, just under 70%, with the sector at 48.5%. Bottom line as well, incredible at 36.43% when we see the sector median at around 2.73. So lots to love here as well. We can even point out their cash from operations on a trailing 12-month basis is incredibly high, 110 billion, when we note that others in the industry are having on average around 85 million. We can also look at the valuation grade. Now, they do get an F rating. One of the reasons for this, when you do look at the sector median, it is significantly lower. Currently, on a non-GAAP basis, on a forward PE, they are trading at 34.42, with the sector median at 23.86. And for those that do look at it on a GAAP basis, 34.41, again, still significantly higher than that of the sector median. But you can argue that for a company which has extreme quality like Microsoft, you would be willing to pay a higher forward PE. But again, just one thing that we are looking at versus a lot of other analytical approaches. Now, when we take a look at others in the sector, we have System Software, Oracle, ServiceNow, Palo Alto, and a few others. Again, we have reviewed the majority of these in detail. We can see over the last year, so total return, including those dividends reinvested, Microsoft are up 38.44%. And we can see, even with that very strong, they are still in the mid to lower of those competitors. Over the last 5 years, we do know, again, in the midpoint with 228%, very, very strong over the period. And over the last 10 years, as I mentioned, this includes now reinvesting those dividends, you would be up a very strong 1,107%. Please, though, always bear in mind in your own investment thesis that past performance is not an indicator of future performance. Now, insider ownership, not that high, 0.03%, although we do note 7 different instances of insider selling over the last 12 months of 94 million. Now, we have to go back to Q1 of 2024 to note around 31 million worth of sales, and then Q4 to see around 9.11. So looking at who these individuals were, what we can see here, in fact, is that the EVP, Kathleen TH, did sell just under 22,000 worth of shares at a price of around $404, netting her just under $9 million. We can also see others here across the board. It does also include US Congress members, but it isn't something we pay particular attention to. As always, though, always do your own due diligence. Never copy what essentially these insiders do, or even what these institutions do as well. So institutional ownership sits at 71%. We see a significant amount of sales over the last 12 months at 126 billion. And in fact, we see a little bit less buys at 98 billion than we do sales. So overall, in the last 12 months, we see more sales than buys. Looking in the more recent quarter, however, we see more buying than selling, 3.13 billion versus 2.66 billion worth of sales. So yes, over the last 12 months, more selling by the institutions. However, in the more recent quarter, we do see more buying than selling. So let's take a quick look now. Before we do jump into essentially the dividend safety and look at the metrics, we do just want to point out that we have released our latest free weekly article. If you want to gain access to this or any others completely free, do click on the pinned comment below. We also want to point out this article here, it is one that a lot of you will find useful, as we get many comments asking what are the websites we use to essentially value and analyze these stocks, so do check that out. But there are also others if you are interested. When we do take a look at their FY24 Q3 results, what is interesting to note that in every single income stream they have grown it by double digits. In fact, the largest ones being the cloud by 21%, and their gross margin, as we can see, is an increase of 1 percentage point. Operating income up by 2 percentage points as well, and both net income and their earnings per share up 20%. So this is a company that does increase a lot of their metrics by double digits, which is why we do talk about this as being a high premium company that sometimes you do have to pay a little bit higher and maybe no margin of safety, but we will discuss that when we look at the valuation. Now, in terms of moving forwards, they are, as we expected, increasing their top line from the previous quarter to around 64 billion, as the finance chief did mention at the beginning, and we can see the split of these revenues. They are expecting this to be an increase on every single stream as well. So lots of positives to note. Again, if you want to see the exact numbers, they are on screen, but the overall message is that they are continuing to increase both on their top line as well as their bottom line and the earnings per share. Now, how does FY25, so the full year, and for this, it would be from June 24 to June 25, just as a reminder, well, they expect total revenue to grow double digits, operating income to grow double digits, and what we can also note is their operating margins is expected, however, to be down around 1 point, but as we mentioned towards the beginning, they are expecting their capital expenditures to continue to increase as they are purchasing more and more NVIDIA products for that artificial intelligence training and usage. Now, in terms of the metrics, so we mentioned at the beginning, 99, very safe, in fact, the safest score. Market cap just over 3 trillion. It is a mega cap company. Now, last recession, they in fact maintained the dividend during the 07-09 crash. They didn't essentially increase it, but they didn't also cut it. In terms of growth, well, negative 8.8%. The S&P during this period had negative 12, and they also outperformed, although marginally, the S&P negative 48, with the S&P bringing in negative 55. Dividend growth, well, what I love about this is consistency. 10% last September, 10% on average over the last 5 years. Over the last 20 years, some very strong increases at 19% year on year, and we can see they've been increasing the dividend for the last 13 years whilst paying a dividend for the last 17 without a reduction. Now, dividend yield theory, it states a company is undervalued when the current yield sits above the 5-year average. Right now, we have a sign of overvaluation on the yield as well as on the forward P, as it does sit higher than the rolling 5-year, and we also note it is higher than the information technology sector at 25.5. Bear in mind, though, we don't look at any of these models in isolation, and we will conclude towards the end. As always, below 60% is the preference on the free cash flow payout. The reason for this, below 60, gives me that faith that we can get those double-digit dividend increases that we've come to love with Microsoft, and earnings data particularly is susceptible to manipulation by management through accounting, as we have reviewed on many other episodes. So good to note, below 60% consistently, and in fact FY24 at 32% is looking very healthy. I would be very surprised if we don't see a strong double-digit dividend increase this September. Free cash flow, always invest in companies that are increasing their free cash flow year on year. Whilst it isn't massively consistent, it isn't massively inconsistent either. It is increasing over the longer term, more than doubled. FY24 as well expected to be an increase, which is always a positive sign for shareholders. Now, in terms of sales growth, yes, 3 to 7% is what we want, but as we mentioned, for a company in the tech market, we expect a lot better, and that is what we can pretty much see for Microsoft. Single digit in FY23, but they are expecting in FY24 and FY25, as we mentioned, strong double-digit increases to their revenue. Now, we've always analysed their sales, but you can see another format here. What they've also done is return that excess cash through shareholders by those share buybacks that we can clearly see. Nearly 1 billion worth of shares bought back over the last 10 years. Remember, in essence, that does give you more ownership over the company with the more share buybacks that they do. ROIC then, return on invested capital, 10% or more, just to give us faith that management are able to effectively allocate their capital. We can see that clearly here. Every single year significantly higher. The last 3 years in the 30s. Very, very attractive to potential investors who do want to see a very strong rate of return. Operating margin, well, clearly we can see the operational efficiency. Not only has it increased over the longer term, but is significantly above the minimums that we want to see. Free cash flow margin, there's a lot of consistency here, above 5% year on year, around the 30s. So this is a massive free cash flow machine and has been for quite some time. Finally, the net debt to EBITDA, so this is the earnings before the interest, tax, depreciation, amortization. These are the number of years it would take the company to pay off all of their debt net of cash on hand. Below 3 is what we want to see. So over the last 10 years, it has been 0, hasn't even taken them 1 day to pay it all off. As we analyze, their cash has come down, even though it was very high, it has come down significantly, around 30%. And we do note now, 2024, it is come up to 0.18. Now, that isn't a worry at all, but just something to highlight here. Now, let's jump into the valuation. As always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, the first model that we're using is the multiples valuation model. Companies in that similar sector and size that we analyzed earlier on. We have their PEs, the average multiplied by the EPS of Microsoft. So again, intrinsic value now, $408. Yes, it is an undervaluation signal, but given it is marginally above the market value, we would give this a reasonable valuation stamp. Now, in terms of the next model, the dividend discount model, we have the yearly dividend growth year on year, just over 10% over the specified period. Forward looking, 7.25%, a little bit more on the conservative side. And we have a second undervaluation signal, although we can see marginally with around 5% upside. We then move on to the DCF model. Now we have the free cash flow year on year, as we can see. On average, it has increased by 10%. Now we have gone in line with analyst estimates at 16%. In conjunction with the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by those shares outstanding, and we can see here now an overvaluation signal. But again, it isn't too far off, so you could argue some reasonable valuation on this model. Now, the intrinsic value is just the average of these three models, and in today's episode, it is arriving at $410. Don't forget, you can click on the pinned comment below so you can get to the intrinsic value as well as the acceptable buy price of companies in your own portfolio and those on your watch list by clicking on that pinned comment. As always, we start off with a margin of safety of 10% and we execute if it meets 3 golden criteria: a wide moat, strong financial metrics, and good forward-looking data. Now, what we note for Microsoft, based on our intrinsic value, it would be a 10% MOS level at an acceptable buy of $369. At 5%, it still isn't quite there yet, and in fact, right now, as we can see, it isn't trading too far off its intrinsic value. So in our opinion, Microsoft is trading at value now. A lot of people will be willing to buy a high-quality company like Microsoft, as we ran through today, at essentially its intrinsic value, or even at a 5 to 10% premium, but this is what we have come based on our estimates. In terms of Wall Street and their estimates, well, over the next 12 months, they do see this as a strong buy. They have a forecasted price of $480 with upside of 18%. Now, this is one of the few that I do hold directly as well as indirectly via ETFs. However, my cost basis is much lower. This isn't one that right now I would be looking to add. I would need to see a lot of value here. But at its intrinsic value right now, it does look like it is trading at a fair price. As always, though, do let me know your thoughts below. Would you be looking to add Microsoft with a margin of safety? Are you happy to buy it at a premium? Or maybe it isn't one that you do want to touch directly at all. As always, if you enjoyed today's episode, smash that like button, hit that subscribe and bell button. And as always, we'll see you all on the next one.